Everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at WisdomTree Asset Management. We're going to talk today income without the volatility or credit exposure. So, if you've been listening to the podcast, reading our blogs, our overarching theme for U.S. fixed income has been and is going to continue to be based on the premise that interest rates will reside at more historically normal levels. But within this backdrop, investors will be facing heightened volatility. And without a doubt, when you look at the Treasury market's behavior through the first 4 months, this landscape has been underscored. And, as a result, fixed income investors will be faced with some potentially challenging investment decisions where, at first glance, a solution may seem like a suitable one, but when uncertainty enters into the mix, an unexpected result could occur. So let's just take a look first at the volatility I just mentioned. When you look at Treasury 2 and 10-year yields reaching their near-term peak readings around mid-October 2023, Treasury fixed coupon yields have experienced a roller coaster ride, to say the least, where we've seen levels go from 5% to about 3.5% to 3.6% and back and forth as we go. But what's interesting is that even within these broader periods of large up and downs, yield levels have also witnessed visible sawtooth patterns. And it's important to note that there is no sector really of the Treasury fixed coupon curve that was spared. And as we can see, it was both short and longer dated maturities experiencing these same results. And it's continued right up here until we're talking to you in mid-May 2025. But there is one sector of Treasuries that has not been subject to this volatility, and those are Treasury Floating Rate Notes, FRNs. And these are reset with the weekly 3-month T-bill auction plus a spread. So as a result, they're anchored by the Fed funds rate and not impacted by speculative trading activity. And when you have tariff uncertainty, recession and or inflation fears, not part of the daily trading mechanism that the fixed coupon maturities are confronted with, that's why you get this lack of volatility in the FRN space. And then there's the credit factor. Now, oftentimes when bond investors are looking to use ultra-short duration as a hedge against volatility, they consider using structures that, unlike Treasury floating rate notes, are not 100% Treasuries, but rather they are concentrated with either corporate credit or collateralized loan obligations, CLOs. And these type of vehicles entail both a rate and credit component as a result. So while ultra-short credit and or CLO instruments can offer somewhat higher yields than Treasury FRNs, there's a reason behind that you don't always think about: potential credit risk. And relatively recently, markets have witnessed a period where the credit component can overtake the duration aspect of a fund, specifically during a risk-off episode. And obviously, I'm referring to the post-Liberation Day sell-off where negative returns for ultra-short credit and CLOs occurred. So while this period of negative activity may be somewhat short-lived, investors who put their funds in the ultra-short duration bucket are not expecting to see potential statement risk, right? So Treasury FRNs are direct obligations of the U.S. government and don't carry that type of credit risk. And the WisdomTree Floating Rate Treasury Fund, ticker USFR, is a means to invest in this ultra-short duration bucket with exposure only to Treasury FRNs. And I'm going to end it there. I hope everybody has a great rest of the week and be well. And before investing, carefully consider a fund's investment objectives, risks, charges, and expenses contained in the prospectus available at wisdomtree.com/investments. Read it carefully.